Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. We talked recently about the performance of superannuation funds across the last financial year. The best performing mega fund was UniSuper, with its default balanced option returning 10.3%. Remember, this is in a year dominated by high inflation, the fastest rate hike cycle in decades, and the ongoing war in Ukraine. Having delivered positive returns across all its investment options, I wanted to talk to UniSuper about where the market's heading, what that means for investors, and of course, asset allocation. This is a big fund investing more than $120 billion on behalf of over 615,000 members. And of course, this is general information only, and you should seek professional advice before making any investment decision. Rob Hogg is the head of fixed interest and macro research at UniSuper. Rob, welcome to Fear and Greed.
Thank you very much. It's a great pleasure to be here.
So last year was a good year, all in all. I mean, a particularly good year for UniSuper, but generally superannuation funds and fund managers had a better year last year than the one before. But it was a little bit unusual in terms of how fixed income and equities worked. No, I was going to say with each other, but maybe it was against each other. Just tell me how the number that you come up with, is that mostly on the back of equities, kind of the roles that fixed income played versus other assets?
Yeah, look, in terms of the contributions then to the return of the balanced fund, the key contributions really came from the equity side, and in particular to a number of the global equity exposures that the fund has. We, as a fund, for quite some time, so more than a decade, have had very significant holdings to the theme of tech. And during the course of the financial year that's just finished, as you'd be very well aware, a number of those larger tech companies did extremely well. So companies along the lines of Apple and Microsoft, for instance, were really key drivers of that performance. So it's really that orientation towards the tech equity sector globally, particularly in the United States. That was certainly one of the key drivers of our performance in the financial year just finished.
Okay, so what sort of role did credit markets, bond markets and credit markets play in the fund last year? And I suppose what I'm heading towards is, are we going to have a more traditional equity bond market trade-off going forward than we've had kind of in the last year or so?
Yeah, look, I would expect that to be the case. Of course, one of the key themes last year was the inflation upside surprise, in the sense that inflation globally probably and still remains higher than expected, and it's been a more elongated inflation cycle than expected. So, of course, that drove up interest rates, both official and longer-term rates, bond rates, both in Australia and globally. So we had a situation where certainly earlier in the year, that negative relationship between bond yields and equity prices was key. But then as bonds sort of levelled out around the beginning of the calendar year, we've then seen equities really start to pick up, more so in some markets than others, particularly the United States. But looking out, with global bonds at current levels, they're not that far away from what I think a lot of investors would regard as a sort of a long-term fair value. We're more likely to see that trade-off, if you like, between bonds and equities, whereas, and that'll be a little bit different, but that'll be normal compared to the sell-off we had with inflation and equity a year or so ago.
Just before we jump into asset allocation, where are we up to, do you think, in terms of the macroeconomic cycle? Certainly in recent weeks, we've seen inflation. It's still too high, but the momentum's going the right way, downwards in terms of inflation. We're seeing rate cycles peak or head towards a peak, lots of conjecture around that. Where do you think we are up to in terms of the global rate cycle and inflation? And then what's that mean for asset allocation?
Well, I think one thing we can be reasonably sure of is that we're closer to the end of the tightening cycle than the beginning. But just how close we are to the end of the interest rate cycle will really depend on the inflation profile. So what we're tending to see, exactly as you said, is that in Australia and globally, inflation momentum, so whether that's month to month or quarter to quarter, and certainly annual change, is starting to ease. But globally, inflation is still generally at quite a high level. And that, along with the fact that the unemployment rate globally is still quite low, the trade-off between the two will be key really in driving inflation from here. And that, of course, will be key in driving what central banks do from here. In terms of what that means for asset allocation, we as a fund are a little more comfortable with bond yields at their present levels. But in fact, what we've been tending to do on the interest rate side of the fund is take advantage of opportunities that have come past over the last probably 9 or 12 months. So, for example, if we cast our minds back to October, November last year, when in the UK they had that linker gilt, so inflation-protected gilt or UK bond sell-off. That threw up opportunities really across the globe, and it certainly threw up opportunities, investable opportunities here in Australia that the fund was able to take advantage of. And more recently, so over the last 6 months or so, the fund's been able to take advantage of the very significant bank bond issuance, and in particular, I mean, bank tier 2 bond issuance. Some of the all-in yields or total yield that those bonds have initially traded at have been extremely attractive and tick quite a number of the boxes that we look for in terms of investments that fit the risk-return perspective.
So just delineating here between government bonds and credit markets, do you think credit markets, effectively being non-government bonds, there are attractive opportunities out there at the moment?
Yeah, look, there are. One of the intriguing things about the current environment is that we tend to find what we feel the better risk-return trade-off lies within these bank tier 2 bonds, rather than, for example, things like high yield bonds. We had expected that at this stage of the cycle, we would be investing again in global and certainly US high yield bonds, but their spreads, which is to say the way investors assess their riskiness, is not quite to the level that we think they provide the right risk-return trade-off. So I think another way of putting that is that investors are perhaps not pessimistic enough about the outlook. So the holders of these bonds, the yields available relative to the government bond of a similar maturity, the spreads and the yield differentials still not at an attractive enough level for us to think that now is the right time.
But Tier 1 and Tier 2, we better explain that one too. So Tier 1 essentially are, I don't know, I'll leave it to you. You're the expert.
Well, yeah, Tier 1 are hybrids. They're often described as, so down toward the very, very bottom of a bank's capital stack, down with common equity. And above that, we have these so-called Tier 2 bonds. Now, one of the big differences between the two markets is that the hybrids are really, actually in Australia, very much a retail market, whereas these Tier 2 bonds in which we've been particularly interested and where we've worked very closely with bank treasury teams, they're really very much a wholesale market. But the difference between the two, there are some tax differences, but it's really in terms of where they sit on the capital stack for banks.
Stay with me, Rob. We'll be back in a minute. I'm speaking to Rob Hogg, Head of Fixed Interest and Macro Research at UniSuper. I just want to quickly mention alternative investments as well, real assets, things like property and infrastructure, and then you go out to private equity and all sorts of things. I mean, many of us think about investing in terms of bonds and equities, but of course, the alternatives space seems to be growing very, very quickly and kind of getting a lot more attention.
Yeah, look, it has, certainly for UniSuper, we have, compared with a lot of other industry funds, we have tended to have lower exposures to infrastructure and property. Well, in terms of the unlisted infrastructure, unlisted property. That, however, is starting to change. We're starting to see more and more opportunities in those areas. So, for example, with infrastructure, earlier in this year, we were involved with a consortium purchasing in Europe an investment called Vantage Towers, which are towers that are used for data carriage and streaming and mobile phones and so on. So the fund spent about $1 billion on that opportunity in infrastructure earlier in the year. And really just more recently, in fact, only just this week, the fund purchased some industrial property assets here and in Melbourne and in Sydney. So these are particular opportunities that have arisen, and we think they are very, very high quality assets that we've been very, very keen to add to our investment options for the benefit of the UniSuper members.
Rob, quite a serious question. How do you keep across it all?
Well,
you work hard, probably, but it's a very big investment world out there.
Well, look, it is. And we have one of the higher proportions of the fund being internally managed. About 3/4 of the fund is internally managed. Almost all the staff, bar one or two, work in the Melbourne office, in open plan, in the office, most of the days of the week. So there's an awful lot of flow that goes between all of the asset classes. So that information flow moves, I think, very, very well. But plainly, there are areas where we really can't claim to have any comparative advantage. So, for example, I was mentioning before high yield in the US. Yeah. If and when we do decide to invest there, we certainly won't be doing that from Australia. We have managers that do that kind of thing for us. With a number of these other global unlisted opportunities, particularly infrastructure, where we're tending to co-invest with other investors that have their organisations and their personnel in the local market. So that's how we stay on top, if you like, or seek and source and fund global opportunities. Really what we do internally in many ways is really just sticking to our knitting, doing mainly Australian assets across the investment team. Where we do global assets, say in equities, there's a significant quantitative overlay to what we do. So I think it's just thinking sensibly about comparative advantage, what makes sense to manage internally, but what makes sense to work in a co-partnership arrangement with global investors.
Rob, thank you for talking to Fear and Greed.
Pleasure.
That was Rob Hogg, Head of Fixed Interest and Macro Research at UniSuper. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.